Will Australian property prices fall? Ever since I have become a property investor in Eastern Europe and retired from my corporate career a couple of years ago, I have been looking out for the next investment opportunity. Having said this, I have been observing macroeconomics, exchange rates, world politics, and property markets in Poland, Australia, England, Germany, the USA, Singapore, and Hong Kong for just over a decade now. It all started with the global financial crisis shattering my belief system in the financial services sector in 2008. I believe that this is the right time now to prepare for an investment in Australia. Based on current knowledge, I expect the market to bottom out sometime around mid to end of 2020. Soon after starting my professional career in 2006 in Australia, I simulated that renting property would likely be more favorable over owning. Nonetheless, I still saved up a deposit for a one-bedroom apartment mortgage deposit in 2008. Later I decided to keep renting in Melbourne. I had a high-paying job and could easily buy in, but I wasn't convinced of the way the market was developing. It sounded too good to be true. It was a sound decision as it turns out, as I would have been tens of thousands of dollars in loss had I bought into the market then compared to today. The government opened up the Australian property market to foreign investors with aim to stimulate growth as the financial crisis panned out. The rest of the world went through a great recession. I couldn't believe this particular decision. In disbelief, I decided to move to Singapore and continued saving and waiting for a better time and/or place to invest. I waited for years while steadily growing my income and war chest, readying it for the next opportunity. Last year's Australian property news might have surprised some Australians and overseas investors alike. Average home prices started declining and accelerated their nosedive with 9.9% and 8.4% in Sydney and Melbourne respectively in 2018. The final quarter of the year was particularly bad. These two cities alone account for roughly 43% of the Australian economy and house 40% of Australia's 25 million strong population. One of the hottest debated questions is how far the market will drop and how long it will take to bottom out. Today I read a very interesting view by Michael Yardney on his Property Update blog predicting a 3 to 6% rise of property prices by 2021 based on further research. With inflation being already at 2.7%, this would suggest we will see a moderate inflation-adjusted drop in prices or a stagnation scenario at best. Personally, I think we have a fair bit more to go before prices stabilize. If property prices were to fall by another 20% over the next couple years, I will be purchasing my first Australian property after all, albeit a decade later than I planned originally. Together with the almost 10% in Melbourne and Sydney in 2018, this would bring property prices back to 2007 levels, inflation adjusted. If prices stabilize before this much-needed correction, and as some analysts are predicting this, I will look for a better market to invest instead. Key indicators for why Australian home prices will continue to fall throughout 2019 and 2020. 1. China, Australia's biggest trading partner, and the US, third biggest trading partner, will likely go into recession within the next 12 months. This would significantly impact Australian business. Australian exports have risen from below 10% to over 30% over the span of the past 2 decades, effectively making Australia heavily dependent on the Chinese economy. Samsung's sales have often indicated weakness in the global economy before significant downturns, and they just announced an anticipated drop in profits of around 30%. Apple, Nvidia, and other global giants have all unexpectedly downgraded their profit and sales forecast in recent weeks, triggering massive stock price declines. Last but not least, all global production indicators have changed directions and are now trending downwards. The economy is most definitely slowing, and a proper business cycle recession in the US is overdue when compared to the historical 7-year cycle. 2. Heavily overinflated prices. The Australian government and the Royal Bank of Australia changed legislation and interest rates respectively in 2008 to allow large inflows of foreign capital. This effectively overinflated Australian prices to an unsustainable level. Yes, Those heroes saved the day for the Australian economy in 2008. However, in my view, they robbed the people of Australia of a much-required breather in the form of a decent property price correction. Prices were already getting out of reach for many people in Australia back in 2007. 3. Housing ownership fell drastically from about 70% to below 65% since the global financial crisis, GFC, in 2007-2008, signaling a growing affordability crisis. This constitutes one of the lowest figures in 60 years. 4. Australia made it to a top of the world, now ranking second only, right behind Switzerland, when comparing household debt by GDP, almost 123%. Australians' households are way too much in debt, with an average of $167,800 in 2016, which was based on a $2 trillion total debt figure. In June 2018, this figure was revised by the Austrian Bureau of Statistics, showing $2.5 trillion Australian dollars in personal debt. Net saving rates is now below 5%, the lowest in 9 years. 29% of Australian households have unhealthy debt-to-income ratios, meaning debt is at least 3 times of their annual disposable income, according to a 2015-2016 ABS survey. Today, on average, household debt is 199% of annual disposable income and expected to grow to 205%. Auto loan delinquencies have risen to the highest level since the GFC. 5. Property prices increased over 100% in Sydney and Melbourne since the GFC, far outpacing the growth of average wages. Living standards have dropped significantly in Australia, with stagnating wage growth and increased housing costs impacting disposable income. 6. The Chinese government has severely restricted Chinese capital leaving the country since 2017. Chinese investors, together with speculative investors and Australian in fear of missing out, were largely responsible for the inflation of the Australian housing market between 2012 and 2017. Chinese real estate investments have since dropped by some 50% between 2016 and 2017. 30% of Australian mortgage debt is interest-only, IO, debt. This is one of the highest figures globally. While 2018 showed a large amount of IOs being reset to include principal payments, 2019 will have the highest number IO mortgages that will need to be renewed. An average of $120 billion worth of IO loans will reset annually throughout 2021, increasing the cost of the average mortgage by 30 to 40%. The recent change of heart of April to loosen restrictions on banks regarding IO lending will not only slow down the inevitable correction, but it will probably prevent the market from crashing and sending Australia into recession. 8. Investor and home buyers' housing market confidence has plummeted to 2012 levels, and awareness of the perils of over-leveraging and interest-only rates is at an all-time high. 9. With net rental yields at an all-time low, about 3%, in capital cities thanks to ultra-high levels of taxations, some of the highest in the world comparing to the markets I look at, falling average rents will force some investors to sell their investment properties. If rental yields equal inflation of 2.7%, you made no money at all while bearing all the risk and work associated with owning an investment property. It is not sustainable for the common investor. 10. Affordability is an ever-growing concern. If the average income in, say, Melbourne is $80,610 per annum, taxes and super alone shave off $23,409 of gross income. The average living expenses for a single person per year are on average $21,840, with an average rent expense of $18,040. It would take close to 10 years to save up just for a deposit for an average house. Of course, the median income is almost 30% less than the average used here, and most young people don't earn anywhere near the average coming out of school. The house price data is based on December figures after taking into account the 8.4% drop in Melbourne home prices in 2018. Today the average home costs $833,321. I think realistically it would take the average young person much longer than 10 years of saving up for an average Australian house unless they receive some form of financial aid. So here you go, these are my top indicators of why I believe that Australian property prices will continue to decline. Let me know your thoughts, and I'm curious to hear if you think prices will fall further and by how much. Do you look at other indicators? For freedom and to live your dreams. Your Financial Gladiator.